This is an uncovered Japan company research report on Nippon Tungsten, ticker 6998. It is a Fukuoka-based specialist that turns tungsten into precision components for hard disk drives, battery equipment, and medical devices. The investment question is unusually clear. Can a small, balance sheet-rich niche leader translate an AI and semiconductor opportunity into better returns, while managing dependence on a China-dominated raw material? At the report's July 2026 reference date, the shares traded at about 12.8 times forward earnings and 0.69 times book value, with a 3.2% dividend yield. The balance sheet is the obvious support, a 70.4% equity ratio, and near net cash financial position. But fiscal 2026 return on equity was only 2.1%, so the sub-book valuation is not automatically a mispricing. Nippon Tungsten's value chain begins with tungsten powder and ends with certified parts and services. Its core craft is powder metallurgy, sintering a difficult metal, then machining it to precise tolerances. That capability feeds slitter blades for battery separators and packaging film, magnetic head substrates for hard disk drives, semiconductor equipment parts, and fine medical wire. Once a component is designed into a customer process, changing supplier can mean requalification and production risk. The portfolio is split almost evenly. Machine parts was 53.5% of fiscal 2026 sales and remains the cash engine, but its revenue fell 4% as EV-related and industrial machine demand softened. Electronic parts was 46.5% of sales, and its segment margin reached 11.1%. Demand for nearline HDD substrates, medical wire, and precision electronic components lifted segment profit by 65.6%. Group revenue rebounded to a record 12.78 billion yen in fiscal 2026. Operating profit was steady at roughly 0.71 billion yen, but the operating margin had fallen to 5.6% from 7.6% in fiscal 2022. The key message is not a simple growth story. The company needs better mix, cost pass-through, and machine parts normalization to convert its revenue base into more convincing returns. Net income fell much more sharply than operating profit because Nippon Tungsten booked a 797 million yen impairment on fixed assets tied to the weak machine parts environment. The write-down was non-cash, and recurring operating profit held up better than the headline bottom line. Still, it is not a free pass. The impairment demonstrates the sensitivity of the business to EV, industrial equipment demand, and the risk that weak assets can need reassessment again. The equity ratio has remained above 70%, which gives Nippon Tungsten resilience against commodity volatility and cyclical demand. Yet a strong balance sheet has not produced high returns. Fiscal 2026 ROE was 2.1%. The report's estimates show recovery toward 5.3% in fiscal 2027 and 6% by fiscal 2029. Management's own longer-term ambition, 10% ROE by 2031, underlines that this is a slow improvement story, not a quick financial transformation. The company has a genuine niche moat, process knowledge embedded in engineers and production lines, vertical integration from powder to finished part, and customer qualification that makes replacement difficult. But tungsten is also the central vulnerability. China controls roughly 80% of world supply, so export restrictions and price spikes can pressure procurement and gross margin. Nippon Tungsten is responding with recycling, tungsten-saving designs, substitute materials, and longer-term supply arrangements. But the risk cannot be diversified away. The opportunity set is credible. Electronic Parts has exposure to AI data center nearline hard disk drives, semiconductor equipment, and medical wire. The 2028 plan also aims to grow service revenue and reduce raw material dependence through a circular model. However, the financial targets are conservative. An operating profit target of 700 million yen or more for fiscal 2028 is around the fiscal 2026 actual and below fiscal 2027 guidance. Investors should look for execution above the plan, not assume the plan alone creates a re-rating. The report excludes fiscal 2026's headline 36 times PE because the impairment temporarily crushed earnings. On a forward basis, the shares trade at 12.8 times earnings, above the clean 5-year average of about 8.7 times. They remain below book, but the right peer group, other cemented carbide specialists, also trades around or below book because returns on equity are low. The valuation is support, not a standalone catalyst. The 3-year scenario range makes the trade-off explicit. The base case implies about 1,871 yen, essentially flat versus the report's 1,897 yen reference price. The bull case needs machine parts margin normalization and stronger electronic parts growth, reaching 2,822 yen. The bear case combines continued EV weakness, higher tungsten costs, and a lower multiple, reaching 814 yen. The balance sheet and dividend cushion downside, but execution determines upside. Nippon Tungsten is a financially resilient specialist with real powder metallurgy depth and exposure to attractive end markets. The counterweight is equally real: concentrated tungsten supply, cyclical machine parts demand, and structurally low returns on equity. After the 2026 re-rating, the report sees the base case as roughly reflected in the price. The next evidence to watch is concrete: margin recovery, electronic parts growth, tungsten cost pass-through, any further impairment, and actions that make the balance sheet earn a higher return. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.